Hey YouTube, welcome back. We're going through the 5 systems of wealth. Today we're on number 2. We're going to be learning all about the banking system. We're going to be learning about a term called, get for this, velocity banking. This is an amazing strategy that teaches you how to pay off your debt in 1/3 the time. And we're going to go over this in great detail today. But velocity banking is a term that's used by an education system called Renatus. And so we're giving you an overview of all of this. But I'm so excited for what we're going to share with you today because you are literally going to have your brains melted by the time we're done. You're going to learn how to do this for yourself. The great thing about today's training is you can immediately start implementing this in your life. Let's jump on in. To do velocity banking, we must first start with a budget. Yes, I said the B word, budget, right? Now, I'm going to go over a budget here on the board. It might not match yours. That's okay. It's still going to work. You just take what I'm doing on the board here and plug in your own numbers. Sound good? Okay. So the numbers that I'm going to use come from the Bureau of Labor Statistics. This is information that comes from the U.S. Census on the average 2-income American household. Okay, so after you get paid, right? Uncle Sam gets his taxes out of your paycheck. What happens? Well, a 2-income family here in America brings in $5,000 after taxes. Okay, so that's great, but so where does it all go? Well, it all goes into this lovely little vortex we like to call the bank, either into a checking or a savings account. All right, so far so good. You're all picking up what I'm laying down. So when you put money into the bank, you're living on what's called a cash basis mentality. Cash basis mentality, what do you mean? It means you have $5,000 in, right? And then that's all you have to work with. So you begin to divide up your money into wedges, like a pie. So much money goes for so much. So you have a certain amount of money that goes for the mortgage, right? Or it could be rent. Now, what happens to you if you're driving along, you get in a car accident, or maybe not even a car accident, but the tire blows, right? Which then sends you careening off the road, and then you've ruined your other tires and your axle, and before you know it, you've racked up a $12,000 repair for your car. You're like, oh man, this is hard stuff to deal with, but we all have things that happen. Life happens. Okay, so when you have to pay for something that was unexpected, but you're living on a cash basis mentality, where do you get the money? Well, you can say, hey mom, can I borrow money, right? Might not work. Friends sometimes can help you out. Or you get a loan, or you use a credit card, right? Those are typically how we try to do this. Now, if you don't have access to loans or credit cards, now it gets kind of interesting. Okay, now we're trying to see what bills can I float for maybe the next 30 days and see, you start playing this musical chairs kind of thing, like, well, we skipped the water bill last month, so let's pay that one, but let's skip the electric. And if no one's ever done that and I'm the only one, then so be it. But I do think that I'm talking to some of you and that hits home. Okay, so cash basis mentality, right? We want to teach you how to get off of this type of mentality and how to start taking more control over your finances. It's all about learning how the banking system works. Now, everything you think you know about banking was taught to you by who? Mom and dad? Or where did they learn it from? The bank, right? Now, is the bank a fiduciary? What's that mean? Fiduciary is somebody who gives you financial advice irregardless of how they get paid or anything from it. Their goal of a fiduciary is to give you the right financial advice so that you make the best choices for you. Now, is the bank a fiduciary? No. Bank is in business for themselves. They make money. How do they make money? They lend money out, and then you pay it back with interest, right? So that's their business model. So they're always going to give you advice that helps them do what? Make money, okay? So this is a thing, there's some repeating themes that are going to keep coming in, but we're talking about living on a cash basis mentality. Something happens to you, oh, what are you going to do? Well, let's break down first, before we get into the nuts and bolts of how velocity banking works, let's just establish a budget. Okay, so we're looking at the money that comes in, and then we have to kind of keep track of, well, we're talking about that mortgage year. Well, how much goes towards the mortgage? Well, if we take an average over the entire United States, from Hawaii to New York, down to Florida, up to Chicago, down to Houston, all across the country, the average 2-income American household is living in a 3-bedroom, 2-bath house, that the average price is $200,000, and the average mortgage payment across the United States is $1,200 a month. Whew, that's a lot to say. So there's a loan here that has to be paid. Loan. This is the first banking product that we're going to talk about today, loans. We all have heard of loans. We might have some. So a mortgage, right, we're going to go off of the national average. $200,000 is the cost of this mortgage. You probably got this at 6%. Now, some of you might have way better percentages. Remember, these are averages. So some people in the United States have a higher mortgage interest rate, and some people have lower. So the average across the entire country is 6%. You following me so far? Okay. Next thing that people are paying for, 2-income American family, paying for a car. Now, 2 incomes, 2 cars, 2 car payments. So the average car payment for a 2-income family is about $600 a month. So let's go back over here. So there's usually some kind of auto loan, an auto loan, right? Carrying a balance. The average balance is about $13,000. Again, some are a little higher, some a little lower, because typically you trade in a car and you get some of the value towards the purchase price, and so on and so forth. So again, that's probably also at about 6%. Now the term on these can go anywhere from 5, 6, I've even seen 7-year terms on auto loans. All right, this next number I'm going to share with you might shock you. Right here, credit cards, lines of credit. This is another banking product. We're going to write over here lines, right? Different than a loan, but credit cards. We're all familiar with credit cards, but some people don't understand all the different lines of credit that might be in your life. There could be a personal line of credit, like what's called a HELOC, or there could be things like an overdraft account. We all know of credit cards. These are different forms of lines of credit. So the average 2-income American family has a $15,000 limit. Not bad, $15,000 limit on all of our lines of credit. However, I mean, we're talking about even retail card, like let's say you have a Macy's card, that counts. So, but the averaging, I mean, I'm telling you, here's the thing. We are carrying a $12,000 balance. Whoa, $12,000 balance, and get this, at 21% interest. Yikes, 21% interest. I mean, think about that. That is a lot. $12,000 balance. Now, I'm going to take a break for a moment here and let's talk about lines of credit. Let's talk about credit cards. Because how many here on this YouTube channel think debt is bad? I'm sure a lot of you are like, yes, that's what I've learned. I've listened to other people on other channels, and my church taught me that, or mom and dad taught me that. Debt is bad. Well, okay. Let's put that in perspective. Is fire good or bad? Well, let's put it into context. If I take a book of matches and give that to my 5-year-old, is that good or bad? That's bad, all right? Now, if I take the same matches and I go to the barbecue pit and I start it and I make a wonderful barbecued, chicken and steak and, I love working the grill, baby. That's good, right? As you can tell, I love working the grill. So Good, bad. It all depends. Because you see, here's the deal. Just like fire is a tool, it depends on how it's used. When you have a little kid and you know they don't know how to use it, they could get burned. They could die, right? But if you know what you're doing, not only can you cook food, you can heat your house, you can send rockets to the moon, right? Fire is an incredible tool that we've used to do so many things in our society. So, to say credit is bad is, well, if you don't know how to use it, then it's bad. You're like a little kid and somebody just handed you a matchbook. That would be bad. But if you start learning how to use credit, here's an amazing thing. How do you eliminate your debt? You go into debt to get rid of your debt, because there is what's called good debt and bad debt. It all depends on the efficiency of the debt. Now you're like, what was all that? Yeah, okay, we'll go over debt efficiency in another training, because that is something that'll knock your socks off. But you need to be able to look at your debt, and by evaluating what's good and bad, you can decide which debts need to be paid right now and which ones I can keep because that's good debt. That helps me. What can I do with good debt? Well, I can grow my credit score. What do I use my credit score for? To get more availability in lines of credit. I can use more lines of credit to eliminate more debt, and so on and so forth. We'll go over this more, but okay, so we're talking about credit cards. They're bad. Most people have learned that they're bad. Well, here's why. Here's why we hear that. Because here you are going along someday, and then all of a sudden, oh man, I've got this $300 purchase I need to make. And you're like, oh, I didn't know that this was going to come up. It's my daughter, she's going to the prom, and I'm going to split the cost with her. It's like $300 for her shoes. Yes, I have a daughter, she's gone to prom, and that's expensive. But she took care of it on her own. I'm very proud of her. So, but let's say you have this unexpected expense come up, $300. Now look at this budget. $5,000 is coming in. You take $300, you swipe it on the card, right? Take my card, swipe it at Macy's. Okay, got myself my daughter's prom dress. Woohoo! I'm feeling good, but now, what did the bank do? The bank took $300 out of their lending pool and set it aside so that they can cover that amount. But you have a couple options here. Can I pay that off this month? Sure, I could pay off. I could figure out a way to scrimp and save and pay off that dress. Now, if I pay it off before 30 days, before the billing cycle, how much money did the bank make on me? 0. Now, they made a 3% merchant fee at the point of sale, but they had to reallocate funds. They had to set it aside. And those funds that they set aside and they don't make any money on, well, that's bad for them because they could have lent it out to somebody else and made money. So, does the bank want you doing that? Think about that. If I'm a bank, I use my money and I lend it out to make money. So if you use the card and then pay it off before I can bill you the interest on it, then I'm not making any money. I don't want you doing that. So I'm going to tell you that if I'm a bank, I'm a financial institution, I'm anybody related to the banking industry, I'm going to tell you that it's bad. Credit's bad. Because here's what happens. They teach you to only use your credit card in case of a what?
Emergency.
Emergency. See? You've been trained. You already knew how to fill in that blank. See, you've been well trained to do this. So, even though you've got a credit card and you could make that purchase, you don't. You're saving it for the rainy day. Now, here's what happens. We go back to that example I talked about earlier. Tire blows, and then you go off the road, and then before you know it, you're driving over some cactus if you're out here in Tucson like us, and all your tires are now wrecked, and you ruined your suspension all at the same time. Wonderful. Now you got this great big old honking bill, right? What are you going to do? You're thinking to yourself, that's $10,000, $8,000, $10,000, could be $12,000. How the heck am I going to pay for that? Well, you put it, maybe you get a good deal. Maybe you got somebody that's going to fix it for you, but that you need to pay them parts. Whatever it is, all of a sudden now there's $500, $600, $700 You think about all the tires, all that. So you have to put all that in there. That's easily over $1,000. Okay, so you pay for all of that. How do you pay for it? Because you don't have any extra money. You put it on the what? Put it on the credit card. Yeah, but that was only $1,000, or that was only $1,200. But now thinking about how easy is that to pay off? No, can't quite do it. And then, of course, is it always ever just one thing? Then it's something else. Then like, oh my gosh, I didn't know somebody slaps you with this bill that's been past due. You're like, what? You didn't pay the dental bill? I thought we paid that. And then it's all back in the rears, and there's all of a sudden you got all these extra expenses. So you're like, okay, put that on the credit card, put that on the credit card, put that on the credit card. You know, I'm so stressed out. I need to go get myself a big screen TV, right? Take some time. Before you know it, what has happened? You've racked up a $12,000 debt. Now, can you pay off with $5,000 coming in? Can you pay that off in 1 month? No, you can't. And this is where they got you. Because what are you going to do now? Well, you can't make all the payments. In fact, you can't even make a huge chunk. You just got to, you're like, well, what's the minimum? Right? Let me just figure out what's the minimum I can pay. Right? So I'm going to pay the minimum here, and I'm going to pay the minimum here. And you stretch this out for how long? How long do you think it's going to take to pay off a $12,000 balance, folks? It depends on the fine print, but could take you, 7 years. I mean, here's the reality: is do we ever stop using the card? No. So we're going to keep, even if we pay it down a little bit, then we're going to reuse it, and it's like it never goes away. It metastasizes as like some kind of financial cancer, It's horrible. Believe me, I've been there. I've gone through that. I have been ill-educated much of my life when it comes to finances, and so I've screwed up. Because let me tell you something, folks, in full disclosure, I've gone through 2 foreclosures which led to a bankruptcy. I've had issues before. I had to get educated. I had to have a reassociation in my brain to teach me, because I was sitting there thinking, well, I'm doing everything everybody taught me to do. Why is everything blowing up in my face? It's because I didn't understand the banking system. I mean, well, who has time? What class did you take in school where they said, okay, today, boys and girls, we're going to learn all about financing. Here's amortized interest, here's simple, here's terms and loans and They don't go over that. You just, do what you're supposed to do, and you eventually, you go from school to college, and then you go get a job, and along the way, you've racked up so much debt that you just don't have any way to pay it back. You're like a mini version of the United States. You've just got this huge astronomical debt, and you're like, well, I'm hoping we can pay that off. Maybe by our 3rd generation, maybe my great-grandkids can pay that off. That's how debt is working these days. And we're like, no. Do you want to pass on a legacy of debt to your posterity, or do you want to pass on a legacy of wealth? Well, if you get educated, you have the opportunity to change a whole history of bad financial choices right here and now. So, think about that. Each payment that you're making, minimum payment, 21% interest, 21% interest to the bank. They got you right where they want you. So, now that we're talking about this, what's the minimum payments that everyone's paying? Well, it comes to about $600, and this is over about 5 to 8 different individual cards and lines of credit. Oh, man. So the next number in this budget, right, I call this, what do I want to call this? Maybe cost of living. This is different for everybody. I'm going to put $1,200 here. Why $1,200? Because it just depends. Are you single? Right? Are you married? Married with kids? Did your kids move out and then they boomeranged and came right back? And then they brought more kids with them? What is your budget? Right? This number fluctuates based off of how much food that you need to feed everybody, how much power is being used, water. We're talking about, do you watch Netflix? Do you go out to the movies? Are you buying a whole bunch of apps on your phone? Right? This is Just what does it cost to live the life that you want to live? That's this number here. Now, if we're going off of all these national numbers, according to national numbers, the average two-income American family is putting away in savings $1,400 a month. That doesn't sound right. Do you know anybody who's putting away $1,400 in savings a month? Or better yet, have you ever put away $1,400 into savings? Right? Now, I'm not talking to the 1% of you that maybe did something like that because you won the lottery. I'm talking about just your average two-income American family. No one's putting this kind of money away, so why this big number? Because if you break it down, it's not just savings accounts they're talking about the 401k, which isn't really a savings account, but it's looked at as long-term savings, saving for your retirement. So every paycheck in the two-income American family, so we're talking about a total of 4 times, there's a certain amount of draw. It could be 4% of their pay, could be up to 6%. Some people are putting away 10%. So once you start looking at those numbers and then what people are putting away into savings, then maybe somebody actually has a savings account and they're putting $50, $100, $200 away in a savings account. Now, when I said savings account, why am I using the quotations? Why would I say that? Because the banks can call it whatever they want to. Think about it. They're calling it a savings account. So don't you want to be responsible? I mean, what were you, raised in a barn? Does money grow on trees? You ever heard these things? No, you need to put your money in the savings account. Save for your future. Get interest on your money. Sounds like the responsible thing to do. So what do? We go put money into a savings account. Because if the bank really called it what it was, would you want to put money into it? The savings account is the bank's lending pool. Think about that for a moment. The bank's lending pool. The bank's lending pool. It means this is where they pool all of their money from everybody that banks with them that also has this brilliant idea of saying, let me put money into a savings account. So look at these loans. These loans that come out from the bank. Hey, look at this card. So you might put money into your savings account. You might have 1,000 in there. You might have 10,000 in there. I mean, who knows? But you give money to the bank, and then when you go and buy stuff like a house or a car or student loan, whatever might be out there, what happens? Well, they lend you basically your money back at a higher interest rate, right? Because they're making 6% on average. Well, what does a savings account pay out? Anybody know? 0.0125%. Yippee skippy, right? Don't you feel so good about that? Now look at this business model. They make 6% off of your money, right? You gave them money because you're being responsible, putting it in their lending pool, savings account. So they take the money, they take your money, and then go out and they make money. And then they pay you 0.0125%. I'm telling you, I want to be a bank. Doesn't this make you want to be a bank? I mean, think about it. Hey, everybody on YouTube, come bank at the Bank of Joseph. Give me your money, and I will lend it. I'll pay you 1% on your money, and I'll lend it back to you at 6%. That's great, and it's totally legal to do that. You're called a bank when you do that. So, wow. Let's look at another number right now. Anybody know what inflation is? Now, I don't know at what time you're going to be watching this video, but we have seen historically inflation be as high as 4%, as low as 3%, 2.5% at one point. We've had some good economic times. But let's just say, depending on when you're watching this video, it's somewhere between 2.5% to 4%. That could be what inflation is, because that's what it's been, say, for the last decade or so. Well, okay, so what does that mean? That means, let's go off of the 4% for a moment. If you have $100 in the bank a year ago, what's it worth today? It's worth $96. Even though you never touched the money, you never pulled anything out, it devalued or the inflation of the cost of everything going up and the deflation of the dollar at the same time, you lost $6. Just by putting your money in the bank, you automatically lost $6. Now, but wait, you got paid 1% on that. So go ahead and add back in one more dollar. So you only lost $3. Wait a minute. Okay, so inflation. If inflation's 2.5 to 4% and the bank's making 6%, so depending if it's high inflation or low inflation, is the bank making money? You bet they are. You bet your sweet bippy they are. All right, so, but you, regardless of if the inflation is low or high, you're always losing money. Think about that. You already know, before you put money into the savings account, that you're going to lose money. I mean, you already know that. It's already mathematically shows that you're already going to lose money just from doing that. So if you're a wealthy person, millionaire, billionaire, how many savings accounts do you want to put your billions of dollars into, knowing that you're going to lose money every year? I mean, do wealthy people even do that? Do they even have savings accounts? No, are you kidding me? If they got to the point where they have $1 billion and they earned it, they didn't do it by putting it into a savings account. No, they learned how to invest their money, right? They wouldn't knowingly invest in something that automatically loses the money. Think about that. If a billionaire would not put his money into the savings account, why do you? That's a real question, folks. Look, we need to start thinking first. But hey, it's okay. Maybe we'll make up for it here on the 401k, because I mean, some of you are just putting so much money into that 401k because you know what? Someday you're going to retire and you're going to want that nest egg, right? Oh, that sweet, golden, juicy nest egg that you can retire and live in the life of luxury, maybe in the Virgin Islands, sipping pina coladas, watching the sunset, right? Doesn't that sound great? That's what you have to do. You only have to work 150 years to get there, right? But, I mean, what is a 401k? Think about this, right? It's not a savings account. It's not the bank. When you send money into your 401k, it goes off to the magical, wonderful world of Wall Street. Think about that. Think about the people that are there on Wall Street. What are they doing? You're giving them your money. And what do? They take your money and they go out and try to make money. And then they pay you based off of the money that they make. What's wrong with that? That sounds like a good deal. Now, based off of that model, if they don't make money, do the people on Wall Street lose? Have you ever heard too big to fail, right? Even if they lose money, we're still going to, as taxpayers, bail them out. I mean, think about what happened. What happened back in 2008? Does anybody remember? Housing market crisis, right? What happened overnight to your 401k? Just like that. 401k is now a 101k, right? Think about it. The brokers in Wall Street, they get paid per transaction. Now, some of them might have some incentives to actually do more for your money, but in reality, they're going to get paid regardless of your performance. Maybe they don't get paid as much, but they're still going to get paid. But let me ask you this question. Seriously, think about this. Do you even know when you put money out into your 401k, where is it invested? What companies are you in? Are you even investing in United States companies? Are you investing in foreign companies? I mean, my mutual fund, I don't know, what's your return on that? I mean, if you're an aggressive investor and you know what you're doing, you might be making 8, 9, 10% on your money. It's possible. But what's the average person making? The person who's like, I just set it in there and I don't even want to look at the statement. I just hope that, you know, in 40 years from now, 20 years from now, that there'll be something in there. Right? The average person is making somewhere between 1 to 3% return. Right? There's so many people that are making low returns. Now, the stock market's surging right now. And then if you watch this video next week, the stock market's plunging, right? It's up, it's down, it's up, it's down. It's got, you can get whiplash watching. It's like a Geiger counter during an earthquake, right? What are you going to do with the stock market? Well, think about this. They're investing your money. Now, who do you think is better at making decisions for your future finances? You or that broker out there in Wall Street? We might be like, well, I don't know how to do any of this. Well, get educated. Learn about this. Figure it out. Because I guarantee you that you care more about your financial future and your success than the broker does. Now, I don't mean to knock brokers. In fact, there might be a broker listening right now. And you're wonderful people. And I love you. And I love what you do. And I think you've got great products. And if you know what you're doing, go out there. You know what you're worth. Go get what you're worth. Right? I love it. But for many folks, I think that they might, if they got educated, could make better choices than letting somebody that they don't know handle their kids' college fund, right? Their retirement fund that they're going to live on for the rest of their life. So I know I spend a lot of time on that. We're talking about a budget here, but this is where the average Americans are at. So this represents $5,000 in, and it represents $5,000 out if you add it all up. So the cash flow on this is what? A big goose egg. Now what's that mean? Well, if we strip this all away, if we're not looking at this in terms of it being a two-income American family, right? If I just came to you and I was like, okay, here's the deal. I got a deal for you. I've got this investment. It makes $5,000 a month. I mean, it is bringing in the cash. But in full disclosure, it costs $5,000 in service fees every month just to maintain this investment. On top of that, if you buy this investment, in full disclosure, you take all the risk and liabilities if anything goes wrong. Now, what is your average investor going to say if I say, hey, you want to buy this? Now, I always get somebody on the line that says, well, it depends on the appreciation of the asset. It depends on the market trends in the future. Like, you need more information to make the decision. Yeah, I mean, if you have time to be that academic about it, sure, you can always say it depends. But if somebody today said, hey, I've got this deal, $5,000 a month, $5,000 going out, are you in or are you out? Your gut reaction, which is right almost all the time, is to say, zero. No, I don't think so. And you'd be right. I mean, think about this. Those of you who are parents, or remember back when you were a kid and you had parents, right? So that should be about everybody on the line here. When you went to school, what happened at the end of the quarter or the end of the semester? You got this sheet of paper and it told you what? It told you what your grades were, right? You saw that you got an A, B, C, hopefully not Fs, right? Well, that was how you did in math, in science, in history, and all those, English. You would take that home and your parents would be so proud of you. Or maybe your parent and your kids come in and you're like, let's see the report card here, Johnny. All right, good job. Keep up the good work. Well, what if your kid came to you and said, hey, Mommy, hey, Daddy, can I see your report card? Well, folks, this is your report card right here. What grade would you give yourself? Right? I mean, think about it. Hey, son, hey, daughter, I want you to grow up and be just like me, where you too could have zero cash flow. No, think about this. We need to learn. If we wouldn't invest in ourselves, why would other people invest in us? We need to learn how to take, I mean, there's a lot of strength here in this budget, but it just needs to be refocused. That's all. So that we can eventually look at our budget, look at our finances, and say, yeah, I got an A. Hey, check this baby out. Look at my cash flow now. Look at how much debt I have, or look at how little debt that I have, right? That's going to be the report card that we care about. Now, when we look at this, this is just your basic budget. we've been talking, I don't know for how long now, and I haven't even gone over one thing of velocity banking because I had to set the stage. I have to set the groundwork here. You have to understand. Now, your numbers might not be the same, but they're similar. Okay, so stay with me. Now, let's go back to that scenario where the tire blew, went off the road, and then the tires, all of them need replaced, and you got to fix the suspension. Maybe you snapped an axle. Ooh, that's a lot in repairs. Now, all of a sudden, you need 12, 15, 18,000. You're like, wait a minute, at some point, you know, fixing the car, it might be cheaper to just go buy another one, depending on how much damage there is. But let's say you need, let's say you just need $12,000. You need it like right now. Like, you don't have time to wait. You don't have time to go through the loan process. There isn't any money available on your lines of credit. And here walks in Joseph. Hey, I'll lend you the money. In fact, I'm such a great guy. I mean, just go ahead and ask me. I mean, you can ask me in the comments below. Hey, Joseph, are you a good guy? I'll tell you yes. Because guess what? I'll let you choose. Do you want to pay me back at 21% interest? Or would you like to pay me back at 6% interest? You pick. It doesn't matter to me. What would you pick? Now, for those of you who said 6, that's the smart choice. You're like, yes, of course. Who wants to pay 21% interest when you can pay 6%? I get you. I'm with you. Well, let's take a look at this. Now, if I can, I want to shift gears just for a moment here. I want to take you back to the magical time in your life when you were in junior high school, earth science class. Remember that? There was a time when you would say fresh water at sea level freezes at 0 degrees Celsius. I mean, do you agree with that? Fresh water at sea level freezes at 0 degrees Celsius. True? Look, folks, I'm not trying to trick you here on this one, okay? Well, come over here, because we're going to compare that. Does that mean that fresh water at sea level also freezes at 32 degrees Fahrenheit? Look, folks, I'm not trying to trick you. You're probably like, don't know if I would answer. No. 32 degrees Fahrenheit, fresh water at sea level freezes at 32 degrees. So 32 degrees Fahrenheit and 0 degrees Celsius, they're equivalent, right? Right. Okay. Now, if I just make one little change here, and I change it from 0 degrees Celsius to 1 degree Celsius, right? We're just going up 1 degree. Compare 1 degree Celsius to 32 degrees Fahrenheit. Which one is hotter? Right? Which one? Is 1 degree Celsius hotter than 32 degrees Fahrenheit? Yes? Yes. You're right. 1 degree Celsius is hotter than 32 degrees. Now I'm going to see if I can trick you. Let's look at this. 6 degrees Celsius, and then I'm going to change this one over here. Watch out, folks. 21 degrees Fahrenheit. All right? Which one's hotter? Do, 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 do. Which one's hotter? Folks, if you said 6 degrees, you're correct. But wait a minute, how? And that over here, it's a 21. That can't be right. But it is. Now why? Why is 6 degrees Celsius hotter than 21 degrees Fahrenheit? Is it because they're different scales? Yeah, duh. Right? Come on, I didn't flunk earth science. I mean, I got an A. So wait a minute. So they're different scales. So you mean, oh, wait a minute. If they're different scales, do you think the bank is doing the same thing to us over here on interest? When they say 6% on your loan, is that the same as 21% on your credit card? No, folks, this is a different type of interest. This is amortized. Amortized, and it's a one-directional loan. I'll explain that in a minute, but come back over here. What's this? 21. This is called simple interest. And the money here is a revolving line of credit. Amortized and simple. Here's why this is confusing. Because when we went to high school, right after we got out of earth science, we later went on to high school and we learned all about math and all the wonderful things that algebra taught us and how isn't everybody using algebra today? I was just asking my business partner Ray the other day if he could help me calculate the hypotenuse of the right triangle in this other room, and he was really come on, we learned so many things that we forget in college and in high school. But hey, one of the things we understood was simple interest, because if I said this credit card is 21% interest and I have $100 balance on the card, how much do I have to pay in interest? Let me think. $21. Yeah, we all figured that one out, and we all use that. We all understand that. But you know what? They didn't teach you in school. They didn't teach you about amortized interest. In fact, I can't even say it in a normal voice. It's amortized interest, because it's so sinister. It's so ugh. We'll get into that a little bit more, but what do I mean by one directional? Well, here's what I mean. I mean, if I want to get a mortgage loan for my house for $200,000, that means I borrow $200,000 all at one shot and I pay it, and now I own my house. And now, every month, what do? I make my $1,200 payment, it goes to the bank. Another $1,200 payment goes to the bank. Now, what happens if, oh, you know what? The air conditioning broke, and I go to the bank and say, hey, look, I know I just made that $1,200 payment, but my air conditioning went out, okay? And I don't have to get the whole unit replaced, but I got to replace the small module. I need about $600. Can I get $600 of my last payment back? All right, I'll make it up at the end. What's the bank going to say? They're going to go, you're funny. No, just make sure you keep making your payments. You're like, oh. Well, you're like, but wait a minute. I've got equity. Yeah, you got equity. Try going to the HVAC guy when he shows up and says, let's see, do you take equity? No, he takes Visa, he takes a check, right? So amortized, you borrow the money once and then you just keep making the payments. You don't get access to those funds again. But come this way. Over here, think about this. I have a $15,000 limit. Right now, the balance is at $12,000. Man, I could put another $3,000 onto that limit. As long as I keep making my minimum payments, right, I could still use that. So every time I make a payment, see, 21% goes to interest, which means 79% pays down the principal. It's revolving, means I could pay that all the way back down to zero. I could pay it part of it. I could keep going up and down, and I can keep using it as long as I'm making the payments. And every time I make a payment, I'm paying principal down enough so that if I paid $600, well, 21% of that went off to interest, but the 79% of this is something that I could use again. So if I racked up my card all the way to $15,000, but I made my minimum payment, do I have enough on my credit card to go get a tank of gas? Well, I do, unless I live in Hawaii, because I was out there, man. It's like they ask for your kids as a deposit. The gas is so expensive out there. But anyway, you know what I'm talking about. You can use it, pay it down, use it again. That's what we mean by revolving. And it's at simple interest. Now, this is all well and good, but let's see how much 6% amortized interest costs. Because what are we going to do? We're going to look at an amortization schedule. Those of you with weak constitutions, you may want to shield your eyes. Okay, fair warning. This is purely evil. So we are making a $1,200 a month payment. So let's put $1,200. This is our total payment. Now, of the payment, we have interest and we have principal. Now, over the life of the loan, you will pay this all off. How long is your average mortgage? 30 years. Now, on payment number one, $950 is going to go towards interest. and $250 is going to go to your principal. So, folks, let's take a look at this. $1,200, your $1,200 payment. $950 goes towards the interest. Is that 6%? Yeah, I don't know. I'm not really that good at math. But I'm thinking maybe not. But if you see here, all the interest is front loaded and then the principal gets back loaded. In fact, there's this magical amount when you start paying more towards principal. And this is usually somewhere like 20, 22 years into your loan. Whoa. Well, let's give the bank the benefit of the doubt, because they wouldn't try to deceive us with a 6%, would they? No. I'm sure there's some sort of truth in lending statement that you would have signed. Right? Let's say, hey, 60 months. 60 months in, which is what? 5 years? 5 years. What happens at 5 years? If you have a house 5 years from now, what's going to happen? Now, some of you are thinking, hey, maybe I refi my loan and get a cheaper payment. That's what some people do. Or maybe you move, because every 5 to 7 years, Americans, we move because we get bored, right? So we move. And then what happens? Well, you just reset all the way back to zero and you start paying all over again. But look at this. Look at this area. Now, how much of the principal did you really pay off? Ooh, not that much. In fact, let's look at where you're at in 60 months. In 60 months, all right, 60 months, you've made $71,000 in payments. Paying your $1,200 a month every month? $71,000. Good for you. All right, let's see. You have paid exactly, well, not exactly, these numbers are rounded, but you've paid about $13,000 in principal. Hey, $13,000. Nothing to sneeze at. But down here, what about your interest? $58,000 of interest. Whoa, $58,000 of interest. But hey, it's 6%. You know what? I'm starting to feel like that doesn't seem like 6% anymore. In fact, you want to know what the reality is? That it's amortized interest, and we need to, because we think and we learned in school about simple interest, we need to think of this in terms of simple interest. Now, is there a way to convert from Celsius over to Fahrenheit? Is there some mathematical equation where I could take and figure out what actually is 6 degrees Celsius in Fahrenheit? Or could I calculate what is 21 degrees Fahrenheit in Celsius? Yes, of course there's a formula. In fact, I'm going to teach you a formula on how you can look at an amortized interest rate and figure out what is that in simple interest. Now, this formula I'm going to teach you is not 100% accurate, but you'll see it's pretty close. So here's what you do. When you see your interest rate, right? So we're going to go over here. Let's do 6 and then multiply that by 2. Multiply that by 2. What do you get? Folks, get 12, right? Now, here's what I want you to do. Multiply that by 10. What do you get? 120%. The real conversion, for those of you, 116%. But do you see how you could just eyeball it? Hey, if you have a 5% amortized interest on your loan, take 5 times 2, and see that's 10, and then 10 times 10, that's 100% interest. You know, it's really like around 90 something. But still, could you imagine what the bank would do? You're sitting at the bank, you're across from the banker, and it says, well, we're looking over your documents, and I think we got it all about wrapped up here. Hey, congratulations on your 116% loan. You'd be like, wait, what are you talking, 116%? Get out of here. I'm not paying you 160%. And the banker's like, yeah, shoot, no one's saying yes to this. Hey, Joe has this idea. Let's call it Amortized interest. Yeah. Okay, have a huddle. Hey, congratulations, you got approved for 6%. Now, you're like, hey, I'm going to go back and brag to my buddies, hey, I got a 6% loan. And your buddy's like, I got 4, dude. And you're like, oh, man. It's like, guys, even if it was 4%, think about that. That's somewhere around 80% in simple interest. So, I mean, if you look at that, what are you going to pay if you were to hold on to this loan for this house for 30 years? What's the total amount you're going to pay? Total amount you're going to pay $420,000. $420,000. So I'm asking you, is that 6%? Because sometimes when I think of 6%, I'm kind of doing my math and I'm thinking, well, 10% would be like 20,000. So 6%'s got to be less than that. I don't sit there and think, oh yeah, 6%. $420,000. Folks, let's go back in time to when I asked you the question, hey, remember, I'm a nice guy. You needed that money and I was going to lend it to you. I'm going to let you pay. Do you want to borrow the money at 21% simple interest, or would you like to borrow it at 6% amortized interest? You pick. Now, how many of you are picking, I think I'll borrow that money from you because I need it at 21% simple interest? Think about that. Think about that. Now that you know the difference between simple interest and amortized interest, can you go out and immediately start making better decisions? But you're like, how am I to know which is which? It's really easy. If it says loan, it's amortized. Your home loan, right? Your auto loan, your student loan, that's all amortized interest. Lines of credit, that's simple interest. Credit cards, overdraft accounts, things like that. They're happening at a simple interest rate. All right, now still, I haven't even yet started talking about velocity banking. You're like, I know, I have to help you. I have to set the right mindset because, see, this is what the wealthy know and understand about the banking system. So if somebody's going to go buy a house and they get a loan, and you're a wealthy person and you get a loan, you're doing everything you can to get out of that loan, right? Because sometimes you have to buy a house with a loan. It's what makes sense. But as soon as you get that, maybe you lease option it, maybe you find a way to refinance out into a different line of credit, but whatever it is, you're not going to hold on to a loan because look at how expensive they are. Amortized interest is raking you over the coals. It might be good for an acquisition strategy, but there's got to be an immediate plan to get out of this in the next 5 years or less. Right? Now, look at lines of credit. Yeah, I mean, this is so convenient to be able to, again, use $15,000, pay it off, and it goes up and down, up. You have so much more control over this. In fact, here's something I'm going to do. I need to erase something here because I want you to feel like you got your money's worth today. All right? And what I mean by that, if you only learn one thing from the day, it's this. Okay, your W-2 folks, what's a W-2? It's your employees. Your employees, right? You filled out a W-2 form, you're working paycheck to paycheck. Maybe you're on the 40-40-40 plan, right? You work 40 hours a week for 40 years of your life to eventually one day retire on 40% of your income. That might be you. Well, what do? Well, the W-2 folks, they use their cash as currency. Currency. Well, what's that mean? That's what I said earlier. You're living on a cash basis mentality. Cash comes in and then you spend it and it's gone. But what do the wealthy do? What do the wealthy do? Well, here's what the wealthy do. They use leverage as currency. They use leverage as currency. Think about that. Leverage as currency. What's that mean? It means a line of credit is somebody else's money. OPM, right? We love OPM, other people's money. I'm going to leverage other people's money and use that to pay for things. That's currency. Now, here's the second thing that wealthy do. They use cash as velocity. Now, you're following along, you're like, yeah, I got that, yeah, I got that. And then I said cash as velocity, and you just went, What does that mean? Cash as velocity. They use cash, the cash flow in their life, as a means with which to pay down the debt. And the more cash flow, the faster, the more velocity is used in paying down the debts. And when you pay down those debts, the greater your leverage becomes, which means more currency you have, the more you're able to do stuff, whatever stuff is for you in your life. All right, that right there, this is really the whole crux, the whole foundation, the cornerstone of what velocity banking is. Now, you guys want to see how to actually do velocity banking? Good, because if you're still here with me, that means you must have said yes, or your mouse fell asleep on you and you can't click it to get off. All right, so stay with me now, folks, because at first you're going to be like, huh? Okay, this $5,000, right before it came in and we put it straight into the bank. Now here's what I want you to do. I want you to take $5,000 and, we're going to bypass the bank and we're going to put it right here onto our line of credit. All of it. You're like, what are you, a crazy madman? How are we going to pay the rent? Mortgage? How are we going to pay the car? How do we eat? All we've done is give all our money to the credit card. Well, guys, stay with me. I said stay with me. Okay, so how does that work? Come on over here. Take a look. So let's say this is our $15,000 limit. All right? And we'll say that this represents our $12,000 balance. Well, if I put $5,000 onto this line of credit, what happens to my balance? It goes down, doesn't it? But wait a minute. I've got so many expenses over here to pay. Well, what are we going to do? Well, come on over here. Let's take a look. So if I put $5,000 onto this line of credit, do I need to make the $600 minimum payment anymore? No. We don't have to make that anymore. Now, we spend a lot of time talking about savings accounts and 401ks, and I'm telling you, I can see right through the camera lens, out there through the digital universe, right through your computer. Yes, I see you. And you know what I see? I see intelligent people. Because who else would be listening to me? There's no idiot listening to me. There's only smart people, intelligent people who want to make their life better. And that's you. And you're not dumb, and you're looking at this and you're not going to put any more money into a savings account because you know that automatically loses you money. And you know what? You're the kind of person, you're watching this video to get educated, to learn about velocity banking. So don't stop there. Keep learning about all kinds of investments and what's right for you. Because you want to know something? You are better at managing your money than somebody else. So you know what? We're not going to put money into that 401k anymore. We're not going to put money into the savings account. And then people are like, oh, what? What about savings? What about my nest egg? Hold on there, Turbo. We'll get to there. But hey, if I don't have to budget for $1,400 into savings and $600 to that credit card, hey, I can change what we have to pay. In fact, if I add up the mortgage, the car payment, and then just my living expenses, that's $3,000 a month. So now I have $5,000 coming in and only $3,000 a month in expenses to pay. Now, did I get an extra job? I mean, how did I do this? Did we have to cut back? I mean, are we on the beans and rice diet? Right? No, we haven't touched our way of life, right? Our condition of life. So, but what has this done for our cash flow? I mean, instantly by restructuring how we pay for things, we've just $5,000 in, $3,000 out. We just created for ourselves $2,000 in cash flow. Whoa, Well, what can we do with that? Well, we can do velocity banking. So here's what we do. Now, 3 rules. 3 rules that I'm going to give you. I mean, there's probably more like 72 rules, but I'm going to go over the 3 big ones. First of all, we need to learn how to use credit the right way as the tool it was meant to be. So first rule is this is for emergencies. Now, do we have any emergencies? Praise God. Hopefully we don't. God forbid that something bad happens to you and your family. But that's what the line of credit is there for. Number 2, what else? It's for debt pay down. And number 3, it's for assets. Is there anything there about buying a big screen TV? Is there anything there about going on a vacation? Now, that doesn't mean you can't have fun, you can't go do the things you want to do, but how do you pay for the things you want to do? You pay for it over here, out of your cash flow. So if $2,000 cash flow is enough for you to live it up and go on the wild vacation you always wanted to at miniature golf land, then yeah, that is right. But if you're like, hey, I actually want to do something, I want to go someplace, I have this dream car, house, vacation, whatever it is, and your cash flow doesn't fit it, then grow your cash flow, all right? But right now, this is what you use your credit for. So we just go through our list. Do I have any emergencies right now? No. Do I have debt? Yes, there's a lot of debt here. So $5,000 in, $3,000 out. So what I'm going to do is I have to put $3,000 back onto the card. I put $5,000 on and then $3,000 off. What was the net pay down? Where am I at right here? I'm at $10,000. I just paid that down. Now that was month 1. Well, anything we did once, we could do twice, right? Unless it was skydiving and your parachute didn't deploy. You can only do that once. All right, so $5,000 down, and then we have to put $3,000 back up. You know, now we've paid it down. Another $2,000. We're 2 months into this. Are you starting to see a pattern, right? So, boom, 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 boom. So if we're paying this line of credit down every month by $2,000 and we're starting at a $12,000 balance, how long is it going to take me to pay it down? For all my math geniuses out there, 6 months. 6 months. That's cool. All right, but you're like, there's so many questions right now. I mean, I'm already anticipating them. Wait, how do we... You can't pay a mortgage with a credit card? Come on. And you know what? Some of you actually, you sound like that. I've heard you, right? No, I'm kidding. But you're like, wait a minute. Well, hold on. How do you do that? And you eliminated all of our savings accounts. What do we do if something happens? Okay. Well, let's see if we can take on some, how do we pay for things? What's going on here? This is crazy. So, let's take a look at this. So, there's a couple ways that we could easily take care of this. $5,000, we could actually put $12,000 into the checkings account, and then we have enough to write the check for the mortgage. Easy peasy, lemon squeezy. But another way is you could have an overdraft account. In fact, you could have a credit card that's attached to your checking account as overdraft protection. And when there's nothing in the account and you write the $1,200 check to the bank and they go to cash it, they actually put it onto your credit card as the overdraft. And then someone always raises their hand and says, yeah, well, that comes with fees and penalties and, that there's an interest rate attached to that. You're absolutely right. But look, you're paying, if you do nothing, you're paying 116% simple interest. What is, by using this method, paying a fee and a simple interest rate? You're still saving money. Anyway, you're going to always look at what is best for you in your financial situation and do that. I mean, I'm showing you an overview of how to do this. We actually work with people every day, and we go over their specific information. You should, in fact, be thinking to yourself, if I'm like making any light bulbs turn on in your head, right? You need to contact the wise guys in ties. You need to get with us because we'll sit down and we'll go through this with you. We'll introduce you to an entire education system that will literally blow your socks off. I mean, you're going to have to go buy more socks because they just will keep getting blown off every time you work with us. So, now let's address well, what about savings? What if something goes wrong? No problem. Here we are in month 2. And then all of a sudden, my son, he climbs up the tree, falls out, and breaks his arm, breaks his leg, whatever it is. And then, I don't know, the ambulance has to come pick him up, and we rush him off to the hospital. And you know, insurance only covers so much. And then it turns out that I have to pay out of pocket $2,000 for this whole ride to the emergency room and the cast and all of that. Well, let me ask you a question. What can you pay for with a credit card these days? Maybe the better question to ask is, what can't you pay for? Can I put the hospital bill on the credit card? Of course I can. So right here, put that $2,000, emergency, remember, emergency. Put that $2K back up here, $2,000. And then we just add an extra month. Add an extra month to my velocity banking. And so now all my debt is paid off in 7 months. Here's the real key. Your line of credit is both your checking account and your savings account, because we're never going to use more than half of our line of credit at any one time. Why? Because it's for emergencies. We always want to leave some room in there. All right? Are you following me? This is amazing stuff. My line of credit is both my checking and my savings account. This is good stuff. Okay, so, wow. Look at what just happened. $12,000 credit card balance immediately is all paid off in 6 months. Oh my goodness. 6 months. But we've got a problem. And you're like, how's that a problem? I mean, there's a $15,000 limit here. You're thinking to yourself, hey, it's time to go to Vegas, baby. Unless you already live in Vegas, then it's time to go to somewhere other than Vegas, right? Okay, so that's the problem with what we do. That's why debt is like playing with fire. In American society, what do we want to do? We want to spend our money. We are the biggest consumers. We just got to buy it. Oh, red ball, I got to go get that squirrel. All right, I got to get that. And we spend money. We have to stay focused on the rules. So even though we paid down our line to 0, we immediately have to say, is there any emergency? No. Now we got to pay down debt. Well, we eliminated all our credit card debt. Is there any other debt in this budget that we need to eliminate? Yeah. Look at all this debt. I mean, we're paying 116% here on that. So, how are we going to knock that up? Well, I'll tell you what we're going to do. First of all, when you start using your credit card this way, you're keeping your balance under 50%. You're using the card every month, but you're paying it down more than what you use it every month. In 6 months, you can call your credit card companies and you can get a credit limit increase. And now you're at $25,000. I mean, that's a $10,000 increase. Imagine if we were putting money into a savings account. You scrimp and you save and you cut back and you're like, hey, can we go to Disneyland? No, we're saving. We're saving. Oh, hey, I want to get this new car. No, I'm denying myself. No, well, hey, let's go out to dinner and a movie. No, let's stay in, watch Netflix and have some popcorn. Right, microwave popcorn, right? I mean, that's what happens to us, and we save, and then finally the day happens, and we look at that bank statement, and we see we have saved $10,000, and the bank, They show up at your door like Publishers Clearinghouse with balloons and everything. They've got this big, huge check, and they say, congratulations, we're giving you another $10,000. What dream world do I live in? I don't know any bank that does that, do you? I mean, if you do, leave in the comments below, and we will all on this YouTube channel bank there. No, they don't do that to you, right? But if you know how to use a line of credit the right way, will they give you more of their friends to play with? Hey, look at this. We like this. This guy knows what he's doing. He's responsible. They either think he's responsible, he knows what he's doing, so let's give him more money so we can make more money, or they're thinking, that's got to be a fluke. I mean, God, this guy's going to screw up big time. I'm just waiting for it. Let's just give him a little bit more rope to hang himself. They're one or the other thing. But either way, they'll give you the credit limit increase. So here we are, and now we're at $25,000 in total lines of credit. Now, here's how we're going to play with that. Following along with me here, we're going to come up here, and we're going to remember we don't want to go over half, so we're going to take oops, that was 12. Here. We're going to have $13,000 here, okay? If I can make it look pretty ugly. Okay, so here's $13,000. We have $13,000, and we're just going to take that because, I mean, it's a little bit over half, but as soon as we put the $5,000 on there, it's immediately going to take us well below half. But for the purpose of what I'm trying to say is we're going to take $13,000 on this credit card, and we're going to apply it directly to the principal of this loan. In fact, when you go to do that at the bank, you got to make sure that you say that this is a principal-only payment. And still, they're going to be confused because they're going to be like, wait a minute. You're going to put $13,000 towards this. If it's a principal-only payment, that means you still have to pay your mortgage next month. And you're like, yeah, I know. That's what I want to do. Because what are they trained to do? You gave us $13,000. We're going to give you the next, couple of months off from paying your mortgage. But you don't want that. You want a principal-only reduction in the principal. That's kind of double. You just want you want to make a principal-only payment. Apply that straight to the principal. So, now, if we're talking about this, in this scenario, you're 5 years into it, right? You've made $71,000 in payment, but you've only paid this principal down. You're at like $186,000, $87,000 right in there total. But here's what you're going to do. We're just going to start velocity banking. So if we have $2,000 here to work with, if it took us 6 months to pay down $12,000, how long is it going to take us, to pay down $13,000? How long? 6.5, right? Well, but I mean, 7 months, 6.5, 7 months. Wow, we've just paid off $13,000. What happened? We just skipped ahead in time. And when we skip ahead like that, you don't have to pay the interest at all over the point that you skip. And so, I'm going to fast forward for you, but we keep doing this. Another 13, another 13, another 13, and we velocity bank it down every 7 months. You know what happens? In a little over 5 years, you've paid off the entire house. Whoa! What? Yeah, look at where you're at here. If you just kept making the payments, you're 5 years into this, it would take you 25 years of paying that off. But if you do this, you've paid your house, it took 5 years to get to here, and then we just accelerated over the last 5 years using velocity banking, and now your house is paid off. What? I'm serious, do the math on this. Folks, in fact, if you don't understand this, what I'm saying is you put $13 as a principal-only payment. You skip ahead. You don't have to pay all that extra interest. You're saving over $100,000 in interest. Saving it, right? You're paying down the principal faster. But let's not take my word for it. So every time you're paying $13,000 down, right? I want you to know it's $1,440 in interest, right? You're still paying the bank, right? The bank's making money on it. There's no way around that. But you, for 7 months, you're paying $1,440 on that interest. Now let's come back over here. Over the first 5 years, 60 months, we paid down $13,000 in principal. And it cost us $58,000 of interest. With Velocity Banking, we paid off $13,000 in principal in 7 months, and it cost us $1,440 to do that. Look at this. 60 months, 7 months. $58,000 in interest, $1,440 in interest. Not only is it faster, but it's cheaper, hence Velocity Banking. Now, wait a minute. Did I get an extra job? Am I working overtime? I mean, am I on some kind of government subsidy or what am I? No, we've made no change. But obviously we're cutting back, right? No, look at this. I haven't cut back on our way of living, right? What? You're still watching your Netflix. you're still eating food. Power's still on. Water's running. Right? Nothing has changed except for how we pay things. We are using our lines of credit to pay off our loans, transferring basically all this principal and that's over here that's been amortized and putting it over to here where it's simple interest. Well, in 5 years, we've probably paid off the auto loan, but you know what? It's 5 years. It's time to go get another car, another couple of cars. So what are we going to do? Well, $13,000, right, on the line of credit, pay that off in 6 months, and we got ourselves a couple more cars. How cool is that? So we've eliminated this debt, got a couple of new cars, so I don't have to pay for that anymore. I don't have to pay for that anymore. Oh my goodness. What is going on here? So my total expense is now $1,200, which means, guys, get this, my cash flow is now $3,800. $3,800. Whew. Now, we can go to a lot of miniature golf parks now. I mean, if that's what you want to do. But no, we're growing our cash flow. We're being more efficient. But, guys, we got another problem. We have got another problem. Problem is we're all out of debt. Go back here. Any emergencies? Nope. Any debt? No. Time to go to number 3. Assets. Because we stopped putting money into that 401k, but there's somebody on this line saying, I don't know if I want to give up the 401k. I get you. I feel with you. I'm with you. Right? We're going to create our own investments now. And we have the money to do it because are we at $25,000 in lines of credit? No. And 5-6 years from now, if we keep following this plan, we probably have access to about $75,000 worth of lines of credit. We also have a house that we own free and clear. Oh, my goodness. Can anybody say HELOC? Yeah, let's go get a HELOC on that bad boy. I'm running out of room to write on here. But here's what we're going to do. We're going to go get a HELOC. HELOC. We're going to go get ourselves a HELOC. Now, when you're working with us, we'll help you find banks that can lend anywhere from 90, no way, to 100% loan to value. No way. Yeah. I just had dinner with a guy the other night, and he got 100% loan to value through this credit union. I'm telling you, this is great stuff. So if our house is valued at $200,000, and let's say we're going to get 90% loan to value, that's access to $180,000. Now, we also have access to 75 over here on our regular lines of credit. But hey, do we like HELOCs? Home equity line of credit. Line of credit. Is it a loan or is it a line? Is it amortized or is it simple? Is it one directional or is it revolving? Guys, we love HELOCs. Line of credit. It is simple interest. It's revolving. Oh, we're going to have access to this with these funds. So with $180,000 on that line of credit, and then $75,000 with our credit cards that we've amassed over the last 6 years of doing this, think about what we can do. We have access to $250,000. Could we go buy a house outright? Sure. If we wanted to, we could take all of this, that line of credit, and we could take this line of credit, combine it, and go buy a $250,000 house. Average rents, $1,200 a month. Now we're creating some cash flow. How cool is that? Right? We could just do that, but we don't have to think small either, because we could get loans on those houses. Not loans that we want to stay into for any length of time, but we could put down payment on 2 or 3 houses with that kind of money, right? And then put tenants in there and they could pay off the loans for us. Or you could get a little crazy and you could use some creative acquisition strategies like contract for deed subject to. You could do an option. You could do an all-inclusive trust deed, also known as a wrap. You could do a master lease, a land contract. There are so many different ways where you can get into property with no money, no credit. But once you get into those properties, do you need money to fix them up? Right? Do some of them come with some outstanding debt that needs paid off? Sure. Do we have the lines of credit to take care of that? And do we have the velocity banking to pay it off? You bet your sweet bippy we do. Oh yeah. Guys, at this point, we have so many trainings. One of the next lessons we're going to do in this series is the real estate system. And we're going to show you how to leverage this. I mean, do you want to get 10 doors, 20 doors, 1,000 doors? We're going to go over how you can get all of these as rentals. Maybe you like fix and flipping and you want to put together, a huge business model where you use other people's money and you use lines of credit. When you start understanding this system, right? This system is awesome because here's what the truth is, folks. I'm going to close on this. This is the banking system. I've showed it to you. This is what the wealthy know. This is what they understand. And because they understand it, they leverage this system to their advantage. And you should too. Because if you don't know how this system works, the banking system, you don't know how it works, I guarantee this system will take advantage of you. And we don't want that to happen. So get educated. Get off your butt. And I want you to come and click on the link that's on the screen. And you get on our website. You give us a call. And we're going to help you implement this in your life. We're going to show you how you could, if you were in this situation, how would you like to pay off a house in 5 years without changing your income, without making extra payments? Imagine what your life would be like if you were debt-free. Imagine, once you're debt-free, if you had the ability to use lines of credit to invest in all kinds of opportunities and make your dreams come true. Folks, there's no shortage of dreamers out there. There's only a shortage of those who will do whatever it takes to make their dreams come true. I challenge all of you, click on the link below and come work with us, and let's make your dreams come true.